So today we're going to be talking about house prices, mortgage interest rates and mortgage products, and obviously the Bank of England base rate which has been held. So stay tuned and we'll be covering all that stuff today. My name's Mark Ashworth.
I'm Neil Harding.
And welcome back to Property Insight. So a bit of a market update, Neil.
Yeah, so first news was Bank of England committee met on the 1st of February and held the interest rates at 5.25% for probably the fourth, if not fifth time in a row where they held the rate. Yeah. So
what does that give us any indication about anything in particular, or?
Well, the voting was interesting, I thought, in that two members of the committee voted to increase the rate, but actually one member of the committee voted to decrease the rate, which is the first time that we've seen that for a while. So the sentiment is now starting to move ever so slowly, but probably surely, towards lowering the rate, which is probably good news for borrowers and for property investors.
I think that it's, and obviously there's a bit of an indication about the long-term swap rates as well. I think that's a very important measure that property investors should probably keep an eye on. My view is that the mortgage interest rates will probably drop before they go back up again. I do sort of foresee that could happen. But you know, it's anyone's guess, isn't it? There's a lot of things that's happened in the last 10, 15 years that nobody could have ever predicted. So yeah, predicting and listening to predictions and certainly basing your decisions on predictions is probably rather futile. Personal opinions only, and use it as you will, but definitely not construed as financial advice.
Yeah. And what's also quite interesting is that now the Bank of England base rate for first time in probably at least a month or two is higher than UK inflation. So obviously the Bank of England base rate had been increased many times over during the course of the last 12 months to try and curb inflation, which was at double-digit levels. Inflation in the UK is now at 4% and has been for 2 months in a row, roughly 4%. Yeah. So with a Bank of England base rate of 5.25, you can see why they're now thinking, well, do we actually really still need to be increasing rates? You know, inflation's come down, but I think they're probably going to want to see inflation held steady at no more than 4%. I think they'd probably like to see 3-something% for a month or two before they think about lowering.
It's interesting what we get used to, isn't it? Because, you know, when we think about 4% as an inflation rate, we kind of think, oh, that's quite good, but actually it's still fairly high to what the intended target is. Remember, the government kind of want to see around about 2% inflationary rate each year. And obviously at 4% it's still pretty high. But obviously nowhere near what we've seen, you know, around the 10% level. And obviously there's this thing that people discuss about it being, you know, real inflation. What does it really feel like in the pocket? And I think for most people it's felt more than what they've actually suggesting. So in some way they're kind of suppressing that inflationary rate somehow by using statistics, I guess, that aren't necessarily always, you know, common to the people, let's say.
That's right. I found an interesting graph which is sourced from the Bank of England, which gives a forecast for base rate going out the next 5 years. And interestingly, there's quite a dip. So we're at 5.25% at the moment, as we're saying. So in 12 months' time, that's estimated to be just above 4, so 4.2%. In 2 years, 3.6%. And then in 3 years, 3.4, and 4 years, 3.3, and probably stabilising around about that sort of number thereafter. The forecast that I'm looking at doesn't go beyond the 5th year, but actually, you know, 3.6, 3.4, 3.3, clearly there's an estimate there, there's an expectation there that 3-something% is where we'll be within 2 years.
Wow. Very interesting.
Yeah. So that's going to have quite an impact on probably mortgage products.
Yeah. So let's talk about, nice segue there into mortgage products.
Yeah.
In my on-the-ground experience, I'm finding that mortgage lenders are a little bit more reticent to lend, particularly on more, let's say, non-straightforward properties, ones where in the past, let's say, they've been in a condition where I've been able to borrow. Certainly properties which are in a condition which are not necessarily rentable in their current condition, even though they are habitable, we're finding that there's a bit more reticence to lend, and so therefore there's probably more deals like that which end up having to be cash purchases, or certainly private investor purchases, or bridging, let's say. Yeah, I'm not sure about your experience on that, because you've done a couple of deals lately that have been bought at auction, haven't you? So
I have, yes. So those ones are private investor finance, so not so relevant for mortgage products. But I have, what's been quite interesting, I spoke to my mortgage broker this morning. I've got a couple of remortgages that are going through at the moment for 2 properties that I actually own directly in my own name. What's interesting is the application started about 6 or 7 weeks ago for those, and they're due to complete at the end of February. But the latest rates from that provider are 0.5% cheaper. So for those that don't realise it, just because you applied for something 6, 7, 8 weeks ago, and you might now be at a point where you're ready to remortgage, you might be 2-3 weeks away from actually completing on your remortgage. There's nothing stopping you from speaking to your broker again, just to double check, and I always do this, double check, what is that lender now offering? And if it's cheaper and a better rate for me, can I move on to that instead? Don't forget, you've already paid for your valuation fee by this stage. The conveyancing is already probably good to go. So on these particular 2 remortgages, I'm going to be about £1,000 a year better off, which is very significant and very well worth having. But that was really interesting.
So this is up until the point where you complete on your remortgage, right? You can change your product.
Yeah.
Because everything else that the lender will have needed to do will have already been done, and so therefore it's just a case of we've got a new product now. And likewise, if it goes the other way, if you've locked in your deal, if you've had a chat with your broker and he said this is the deal, and the rates go up and that product is no longer available, if they've already locked in the deal and you're doing your paperwork based on that mortgage offer, then they have to keep it, that mortgage offer.
That's right.
So it works in your favour both ways, but it is definitely, absolutely 100% Neil's correct. You need to check with your broker before you do the completion.
And what's particularly of note is the mortgage works. So the mortgage works, who are often the first to move actually on lowering rates and making their mortgage products particularly competitive. This is the buy-to-let lending arm of Nationwide. So they have got some quite sort of eye-catching rates. So I'm just going to read out a few here. So if you are within a limited company, you can get a 2-year fixed product at 4.99% with a 3% product fee on a 75% loan to value. Obviously there are criteria here to meet. There are other criteria which I won't go into, but just to give you an idea, there's a 5-year fix at 5.49% with no product fee, and that's suitable for people with large portfolios as well as small. They're better rates certainly than I was seeing 6 months ago or even 3 months ago. Also, what's quite interesting is if you own property in your own name, in your personal name, the Mortgage Works have a 3.99% 5-year fix with a 3% product fee, but that is available for remortgages or purchases with a 75% loan to value. And it's been a long while since we've seen anything that starts with a 3 point something percent.
Well, I was thinking, as you were saying, 4.99. I think the sort of like the holy grail figure is under 5, isn't it? So if people can get that rate under 5%, I think they're feeling a little bit more comfortable and a little bit more secure in the market at that level.
Yeah. Now, of course, that's in your personal name. A lot of people now, because of Section 24 and tax reasons, buy in a limited company, of course, we know that. But nevertheless, for a landlord out there that maybe has 1 property or 2, or is thinking about getting 1 property or 2, they might not particularly want a limited company. So that's a great rate for many people out there. Yeah.
So the advice there is to make an effort to connect with your broker and have the conversation, particularly if you've got stuff that is that you're on sort of standard variable rates. So let's talk about house prices.
Yeah. So house prices, so there's been some data released just recently on movement over the last month. So Zoopla have reported a year-on-year decrease of 0.8% in UK house prices in 2023. So I guess they've finalised their 2023 statistics and data and released that stat. And also, what I thought was quite interesting, they state that 1 in 5 sellers are currently accepting more than 10% off the asking price, which is, I thought, quite an interesting stat. I mean, sometimes people say 5% off maybe, but 10% is quite quite a lot. We'll put some links in the show notes as to where this is coming from and the Zoopla report. Nationwide have reported some more positive data than that, with house prices up 0.7% in the month January 24, making the year-on-year decrease from their data 0.2%. So that would be the year-on-year decrease to January 24.
So it sounds relatively static, doesn't it? I mean, it's not going up or down too much.
These are not major headline movements, are they? It's sort of down onesies, twosies. It's not sort of, yeah.
And I think also, you've got this kind of everywhere in the UK has its kind of little micro climates, depending on where you're investing. It's very dependent on people's circumstances. Are people in a situation where they can sit and wait for the best price? That's probably not happening at the moment. I would imagine that agents are, I know personally of one agent who said that their figures were down, certainly in terms of volume, both from a listing perspective and also from a sales perspective. So there are people that are going to need to sell. So depending on those circumstances, you should always be working towards buying properties from sellers who are motivated to sell rather than those that are sitting to wait for the best price, irrelevant really of what the property's like. So obviously it needs to meet your criteria clearly, but as ever, it's a people business, not a property business. And you need to be seeking those people out. There are some videos that we're probably planning to do on some deals that we've each done, which indicate the importance of trying to find properties where people are, wanting to get rid, and the speed and importance of the sale is more important to them than the final price they get.
With a view on what a house price is going to do in 2024, what's quite interesting is, I think Knight Frank, if I've remembered it correctly, have changed their forecast to 2024. They were previously saying that house prices are going to go down by something in the region of 3 or 4%, and now I think they're saying that house prices are going to go up by 4%.
They changed their predictions like the wind, these companies. Savills do it as well. I think Savills got it terribly wrong a few years ago. There was a prediction about them.
That change is probably in a context of the Bank of England's recent announcement that they have come out and said, the Bank of England, that they are close to dropping rates. So that provides some sentiment and a little bit more certainty that perhaps finance will be more cheaply available. But what's also really interesting is, of course, Rishi Sunak's announcement about 99% loan-to-value mortgages for first-time buyers, having only just scrapped fairly recently the whole Help to Buy scheme. In an election year, it's no surprises that there's something in it for people to put a smile on people's faces who are struggling to get on the housing ladder. Of course, people have different views as to whether or not this is going to be a good thing or a bad thing. But what typically happens is, in the availability of affordable finance, let's say cheap finance, and a 1% deposit, makes things accessible, makes credit affordable. People want to get on the property ladder. Maybe you haven't been able to for a year or two or even more. And
encourages the market.
First-time buyers are brought to the market because they want to buy that house and get on the ladder. And as we've seen, whenever that happens, house prices go up.
Yeah, and of course, it's that kind of stock also at that level is the kind of stock that you're looking to buy to rent out essentially. It's certainly the kind of stuff that we do anyway. So.
Yep.
I think that's been a good summary, Neil. We hope that you find some of those comments insightful. And again, not to rely on it for any kind of advice. But if you want us to cover any other topics or answer any questions, please pop them in the description below. And our channel is massively helped if you please like, subscribe, and share the content. So please hit the like button and subscribe if you haven't already. We look forward to seeing you on the next one.